Welcome back, my friends. The shortage of houses is hitting some people and areas harder than others. The supply of homes for sale in the US is about half of what it was in 2019. The shortage is hitting some buyers more than others, based on income and area. Far fewer homes are available to people who make $100,000 a year than just a few years ago. What does this mean for the future of the economy? And what does it mean for the future of the United States? But before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Even in a housing market that has slowed significantly due to rising mortgage rates, the supply of homes for sale is about half of what it was in 2019. The shortage is hitting some buyers more than others. The popular 30-year fixed mortgage rate hovered in the HIGH 6% range in May. At that level, buyers with an annual income of $100,000, slightly above the national median, could afford a house with a maximum price of about $341,000. But just 39% of the homes for sale were listed at or below that price point in May, according to a new report Thursday from Realtor.com with the National Association of Realtors. In a balanced market of supply and demand, 64% of homes should be affordable to buyers who make $100,000 a year, given the size of that population. As a result, the market currently lacks about 285,000 of those listings. Just 5 years ago, those same earners could afford two-thirds of homes for sale. Home prices and mortgage rates were significantly lower. The lack of affordable homes heated up competition in the market this spring, which reversed the cool-down in home prices that started last summer. It's almost a tale of two cities where we have houses under $500,000, they're absolutely selling incredibly fast. Under $350,000 and $400,000, there's multiple offers, said Noah Herrera, a real estate agent in Las Vegas, during an open house in mid-May. Over $500,000, it slows down a little bit. At the higher price ranges, too many homes are for sale for the number of Americans who can afford them. In fact, for every home listing above $680,000, the market is lacking twice as many homes under $341,000. Ongoing high housing costs and the scarcity of available homes continues to present budget challenges for many prospective buyers, and it's likely keeping some buyers in the rental market or on the sidelines and delaying their purchase until conditions improve, said Realtor.com's chief economist Danielle Hale. The pricey existing home market is pushing more buyers to new construction, which, ironically, used to come at a price premium. Home builders have been offering incentives such as upgrades or temporary mortgage rate buydowns. Those, however, are decreasing as builders see more demand and gain more pricing power. As with all else in real estate, location is everything. The areas that have the biggest deficit of affordable homes include some familiar names: El Paso, Texas; Boise, Idaho; Spokane, Washington; several Florida markets; and of course, Riverside in Los Angeles, California. These are some of the priciest housing markets in the nation. Areas in the Midwest continue to have the highest number of affordable homes. The 4 cities with the largest supply of affordable homes are all in Ohio. They are followed by some others: Syracuse, New York; Pittsburgh, Pennsylvania; and St. Louis, Missouri. The supply situation does not appear to be improving. New listings of homes for sale in the first week of June fell 25% year over year to their lowest level of any early June on record, according to Redfin. Some analysts are warning us to get ready for corporate landlording by Wall Street. Corporate and institutional investors are preparing to become even bigger landlords. Home builders are sounding the alarm bells about demand for new houses. Demand for new homes is softening significantly. Traffic in model homes has thinned out a lot. and contract cancellations have spiked. The United States is teetering on the brink of a recession. And a record number of new houses are coming onto the market in many cities. Sensing that home prices are in free fall, home buyers are now pulling back from the market. But guess who is stepping forward to buy houses in bulk at rock-bottom prices? You guessed it, Wall Street institutional investors. Private equity, Wall Street banks, and corporate interests are gathering their cash. They want to bypass the usual home building food chain and make build-to-rent deals to buy in bulk from homebuilders and house portfolio holders. So, is this a good thing? Will it even work? Or will these moneyed interests fall victim to a further crash in the housing market? What does this mean for new home development? Wall Street has purchased hundreds of thousands single-family homes since the Great Recession. And guess what that means for rental prices? Home buying corporations are backed by private equity groups like Blackstone and Pretium Partners. These financial giants bought tens of thousands of homes across the U.S. Sunbelt. And these are detached, single-family houses. That has caused prices to increase more quickly in key Sunbelt states as compared to the national average. Analysts warn that institutional investors will control a large market share in housing within a few years. Specifically, institutional investors may control 40% of U.S. single-family rental homes by 2030. Some Washington lawmakers believe that Wall Street needs to back away from the market. What we're saying is don't have private equity buying up single-family homes, said Representative Aro Khanna, a Democrat representing California's 17th congressional district. Khanna is the lead author of the Stop Wall Street Landlords Act of 2022. What's outrageous is your tax dollars are helping Wall Street buy up single-family homes, he said. The single-family rental industry got its start with government backing. Originally, that was in the fallout after the 2008 financial crisis. It was that rare opportunity that attracted the institutions to build a portfolio out of these foreclosed properties, said Stephen Shao, professor of finance and managerial economics at the University of Texas at Dallas. Since the early 2010s, financial giants have bought in Tricon Residential, Progress Residential, American Homes 4 Rent, and Invitation Homes. They have each bought thousands of homes. They've also added to the housing supply in some cases with built-for-rent communities. Some of these companies are financed by private equity firms, like Blackstone, and investment managers, like Pretium Partners. Even if institutional investors only buy up a small percentage of total housing, their presence in the bidding wars can still lead to higher costs for all buyers. For now, institutional investor purchases have slowed. But experts expect their share of purchases to rise again soon. Home builders are looking to sell unsold homes in bulk to institutional landlords. And institutional and corporate buyers are raising funds of over $100 billion. They are preparing to pour billions of dollars into new build-to-rent communities. Tricon Residential has nearly $3 billion it plans to use to buy and build new homes. We need to massively increase housing supply, said U.S. Representative Aro Khanna. J.P. Morgan Chase has formed a new venture with a billion-dollar real estate developer. The partnership is morphing America's largest bank, America's largest landlord. This starts with thousands of U.S. rental homes. J.P. Morgan announced that it has formed a joint venture with Haven Realty Capital. The joint venture will purchase and develop entire communities of new homes. It is starting with 3 communities in the Atlanta area. Enough capital to acquire more than 2,500 single-family rental houses will be invested. The build-to-rent, BTR, gained immense popularity during the pandemic. Actually, it paired 2 separate but willing constituencies. COVID-quarantined city dwellers were eager to move to the suburbs for more space. Real estate investment funds ready to capitalize on this by developing full-on, turnkey communities. A community is far easier to manage than a disparate group of properties spread across multiple parts of a city. Under the BTR model, housing developments are built on spec, which means without an agreed buyer. The builder tries to get a property management company to buy the entire community of houses as a block. Then, the property management company rents out and maintains all of the community's properties. It is somewhat similar to city rental markets, with the exception that freestanding single-family homes take the place of apartment units. The amount of rental houses increases when property prices and mortgage rates soar. This year, both factors are rising aggressively. Haven already owns 3,500 homes valued at $1.2 billion in 35 communities. Most of these houses are completed, but some under construction. JP Morgan's injection of capital could increase that portfolio by 70%. But if you follow this channel, you already know that big home builders are losing confidence. D.R. Horton, the largest U.S. homebuilder, shared more details in its Q3 earnings call this week. Among the many notable highlights, buyers canceled almost one-third of all purchase deals in with D.R. Horton in Q3. Orders for new homes fell 15% to 13,582 homes as compared to Q3 of last year. But what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.